there, welcome to Shanaz Musical Sensation. Yes, that's right. We launch a brand new topic. Let's talk business. I enjoy talking business. And the other day I met this gentleman, Mr. Conrad Gardner, and we were talking about the market and so many new changes that are happening right now when it comes to mortgage and everything else. So, welcome to our program, Mr. Conrad. How are you doing today?
Doing well, thank you.
I
Thank you so much for the invite.
I could see you're a very busy guy because I heard from your conversation the interest rates went down.
Yes, the Feds did cut interest rates today, so we're getting a lot of phone calls about that. So, we can talk about that a little bit in the program as well. So,
That is great news because as we were discussing earlier, investment properties, a lot of folks are looking into investment properties.
okay.
So my first question to you, what is the difference between buying a primary residence versus buying an investment property? Guys, thank you for joining us on our network, the SMS network in the App Store, Roku TV, Firestick TV, and yes, we are live on Facebook as well. Welcome to our program. Mr. Conrad's number is on the screen as well, so please reach out to him after our program. Shoot him a text, and he will call you back at his convenience. So,
All right. So, just a little bit about myself first. My name is Conrad Gardner. I am the mortgage broker with Channel Mortgage, where we specialize in providing all sorts of financing for everyone from first-time home buyers to sophisticated investors, developers, you name it. So basically, we are a one-stop shop for all of your mortgage needs. But Shanaz, thank you again for inviting me. And as we get into it, to answer your question, we're talking tonight about investment, real estate. There's a lot of programs out there about first-time home buyers, which is great. But tonight we want to focus on those of you who are looking to get into that secondary part of home ownership and get into the investment side. So first question is, what's the difference, right? So when you're an investor, there are a couple of things that are different. Number one, you're expected to have more down payment into the transaction. That's probably the most common question that I get. I want to buy an investment property, but I only want to put 5% down like I could if I was living in the house. And the reality of it is this. When you're an investor, the bank is looking at the transaction alongside you as a business transaction. So like with businesses, they're going to say, hey, listen, have a little bit more input in where this is. Also, when you're in the investment world, a lot of the programs that you would get as a first-time buyer just doesn't exist on there, right? But there's also a lot of different opportunities. So one of the biggest things I would tell you is that the down payment might be the most significant difference for folks. But after that, you actually have way more flexibility in how you can finance as an investor than you could as owner-occupied. Owner-occupied properties typically are full docs, pay stubs, W-2s, the whole nine. You can do the same if you're buying an investment property, but they also have opportunities for you to not show any of your income and just look at the property that you're buying itself as the source of payment. There's all kinds of, you can buy an LLC, whereas that you can't do that if you're going to live in the house for yourself. So, those are just
lots of great opportunities and options, I should say. So, and most folks might get confused. You don't have to have a personal property before you buy an investment property, or
what's the case? Well, that is a little bit of gray area there, right?
I could be a renter and I want to buy something for an investment.
If it makes sense.
Okay.
If it makes sense, right? So if you rent a property and you buy an investment property out of state or something like that, then that could be, it kind of makes sense. I live here in New York, I'm buying something out of state. That's great. Now, what program you get is very different. So even in the investment world, there are fully documented loans. And with the fully documented loan, you do have the option to rent and buy the first investment, but now you still have to go kind of like full docs, right? But if you're using some of the more sophisticated programs, we have programs, you may hear these things, DSCR, which basically is a program where you're just looking at the rental. With those kind of programs, or if you want to buy an LLC or something like that, underwriters want you to have skin in the game, and they also want you to have experience, right? So basically, bottom line is you're an investor. The bank doesn't want you to learn on their dime, so to speak, right?
So their money they're putting out there, so they want to make sure it's secure. You're bringing back income.
Correct. And for those of you who own properties, owning the house is just the first piece of it, right? So you talk about the repairs, you talk about the plumbing, break it down, and the the electric goes out, and
They'll
this
give you a
breaks,
budget for
that
everything
breaks.
because they want to make sure it's
Right. But as a
feasible.
homeowner, you're used to that, right?
Right.
So you're used to being in the house. You just pay the mortgage and the boiler goes out. Oh my gosh, you have to come up with that. You're used to, just things going wrong. If you have rental properties, there's a time the property's going to be vacant, and you have to kind of
You have
manage
to
through
keep
those
funds to
things.
make sure you
have
could
to-
pay your
right.
mortgage.
So what happens in owning a house. So if you've never owned and you want to become an investor, of course the lender's going to be like, well, not
There's a
so
lot
sure.
to learn
there's
a
lot
little
to
bit,
learn.
right?
But there's some things that you could do. You could partner with someone who owns a property, and then together that person can provide the experience that the lenders are looking for. So if
Or I could also call Conrad from Channel Mortgage and ask him for his advice.
you
And
can do that too. Right.
his number is on screen, and his assistant or himself will personally guide you towards the right, option for you. So as you mentioned earlier, how can you get fund for the higher down payments on these more?
All right. Well, that's actually a great question. So what happens with funding on the investor side? They're actually more liberal than on the owner-occupied side, right? So if you're buying your primary residence and you put money in the bank, we want to know where you got the money from. We want to know the person who gave you the money.
My
had the
auntie
money.
gave it to me as a
Well,
gift.
then I want to see auntie's bank account to see that auntie had the money to give you, right? But if you are in the investment world, they see the deposits. A lot of programs don't ask you to source where it came from. They just ask that it be in your account for sometimes as little as 10 days.
10 days.
And that's it. When you're talking about if you were fully documented owner-occupied, traditional Fannie, Freddie, conventional loans, yeah, that funds usually have to be in the account sometimes up to 30 days. And if it's a gift that you're getting right away, we want to see that the person who gave you the gift had the money for a certain amount of time. So
what if she just won the lottery and they want to share that? Well,
then
you
I
have to
need
show
see
the
the
lottery
lottery
ticket.
winnings. I
Okay,
gotta
I
see the
see
wire
that.
coming into the donor's account. I have to see that she got it from the lotto, and then I have to see the check that she wrote to you, and then I have to see that check being cleared in your account.
Got it.
And,
all right. So as long as I could provide proof, it's doable.
Right.
So the next thing is that
But the money under the mattress, though, that's where a lot of
that's a
people
lot
have
of
to
folks.
take.
That's what I was just getting to.
Okay.
A lot of folks from the Caribbean, I don't believe in banking. So, you don't have money in the bank, but you keep it somewhere safe.
Right.
How can you show proof?
Well, what I would say to folks, if you have cash, put it in the bank. Just put it in the bank, put it one time.
The minute you start thinking of investment or buying something, put it in the bank. So you could leave it.
So there's two rules. A lot of people think it's 60 days, but it's actually 30 days from the day you make application. So if you go to contract today, I'm going to ask you for
the last 6.
I do need 60 days bank statements, but it doesn't have to be 60 days from today. You can give me 30 days from when you sign, and then give me the second bank statement during the
from today towards the next 30 days. Okay,
Correct.
cool. So ladies and gentlemen, it doesn't have to go towards a property or investment living wise. What's about the business end of it? I want to purchase a business, invest in a deli, a grocery store.
That's separate financing. So
that's commercial finance.
That's business financing. It's not quite the same as residential financing, right? So when you're thinking about mortgages, there needs to be a property that's associated. Now, if you are looking to purchase a business and you're also looking to get the building at the same time, then there are loan programs that allow you to do both. So the SBA actually has a really, really good program for business owners that would let you put actually as little as 10% down.
Not 10%.
Right? If you're operating the business.
Owner operator.
Right. So if you're the owner operator, you can do as little as 10% down. But with that program, that's full documentation. You're talking about, of course, SBA, which is a government program, which, it's just
proof. As long as you have your proof.
Yeah.
Can you use a gift or fund for investment properties? I think we answered that one earlier. Yes. You just have to provide, if your auntie give it to you, where your auntie's getting it from. Or your uncle.
Right. Well, with the investment properties, we just know that auntie gave it to you is fine. We don't need to know how long auntie had it. That's the difference, right? So when you talk about an investment, let me step back for a second. The reason why there's so much documentation and there's such a difference when you're an owner occupant versus an investor is that when you're an owner occupant, the you have a lot of protections that's afforded to you by federal
Federal.
and state regulators, right? So they always want to make sure that the consumer is protected. So and what they want to make sure is that there's not some innocent person that I come and say, hey, I'm going to give you some money, go buy this house for me, right? Because then
Right.
now you get into
Business
so,
deals.
yeah, straw buying and all that stuff, which is totally illegal, right? So in order for the lender to give you those protections, they have to make sure that they check everything out. Again, now when you switch to the investor side, it's a business, right? And anyone who knows a business, hey, listen, I need to come up with 30, 40, $50,000. And for those of you who own businesses, sometimes you're taking a little bit from here, you're taking a little bit from there, and
You pull out together.
exactly, you kind of pull it together. And when we get to the investment side, we just want them to see that it's there. And if we know that it's there,
It's a little
that's fine.
security.
We're not going to get into, oh, where did you get this part from, or where did you get that part from? Not on the investor side.
So that brings me to my next question. How do you know if the property is a good investment? You have to hire your own inspector, I believe, or sometimes the bank.
Investment as far as what the property is, or is the building itself?
Is the
safe?
building,
Okay.
yeah.
All right. Well, okay. I was thinking about it in a different way.
Well, you could answer me both ways.
I will. That's actually a really good question. So as far as the building itself goes, I would always recommend that you use a building inspector, right? I've purchased investment properties of my own, and I still use.
I would do the same. You want to make sure you're not buying a pig in the bag, as they were saying in the Caribbean.
Absolutely. And it happens, right?
It looks great in the outside. Inside, you don't know the plumbing, you don't know the electrical, what's going on. So you need to get your personal or a private,
And sometimes they say when you know just enough to get yourself in trouble, right? So you may have someone who owns their own home right now, and you feel like, yeah, I own a house. I
know the do's and the don'ts. I could get around it, right?
And so forth. But then you buy that investment property, and then you realize, oh man,
It's
the
a lemon.
foundation is cracked. And when you're looking at the house and the excitement walking through the house, you're just looking at, ooh, nice, ooh, la, la. You're not paying attention to the things that
And
an
structural.
inspector, right? And inspectors come in there to look at very specific things. So even if you are buying that investment property, it's worth the $400-500 or whatever they charge to
Get a professional
get that, and they write
opinion.
everything up, and they'll notice things that you don't notice. So I would always recommend that, because then you know what you're getting into. So that's one of the biggest thing in terms of whether or not the property is safe. And then the other thing that I would tell you is make sure that you do things like check your certificate of occupancy. I've had many clients who come to me think they're buying a 3-family house. Actually, I have one of those cases right now. It's not a 3-family. It's a
two.
very large 2-family that they put 3 apartments.
And they didn't convert it properly. The
Correct.
paperworks are not there, so you're not buying the
You're not
paperwork.
buying a 3.
Right.
Here's the ironic part. The seller thinks he owns a 3.
Okay.
Okay. I just got title back. It's a 2-family house.
It's a 2-family.
So right now they're in the middle of contract, and it's kind of like, okay, well, you tell me.
And how difficult is that conversion?
Well, it depends, right? So when you're thinking about conversions, you're thinking about the natural zoning for the neighborhood. So every neighborhood has a zoning.
Right.
So if you drive around any place in the city, you'll see that some places are all single-family homes. Some have 2 families, some have 3, some have some mixed-use commercial. So that's all pre-planned by the town. So you want to always make sure that the property you're purchasing is in line with that zone.
Sometimes you could think you're buying, or they said it's a 3-family, you buy a 3-family, and the paperwork doesn't match.
Right,
What
it's a 2.
It's a 2-family.
And then here's the funny part. We're going to finance it as a 2. So which means the appraisal is going to be appraised as a 2,
As a
which
2-family.
means chances are it's going to come in lower than what you
Than you
expect,
expected.
right? And then, of course, that's where folks are like, oh, get another appraiser, find another bank. And you're like, listen, 2-family house is a 2-family. 2-family house is not a 3-family house.
Right. Different budget.
Different budget, different numbers, different everything.
So give me a scenario of, you deal with clients in and out every day, something that came up surprisingly that, you thought they knew of, and
Oh man, that's every day. Okay, what do you think people know? Actually, well, the one that I just told you is a really, really good example. I've had this is very, very interesting. When I tell you to check the zoning, I had a client who purchased the property. It was a double lot, so she bought it from an investor. And when they purchased the lot, her deed referenced the entire lot. But what the seller did was subdivided the lot and somewhere the paperwork got missed. So she closed on the whole lot, and then the seller sold the back of the lot to someone else.
She
Lost
thought
it,
she bought the whole entire lot, but it wasn't.
but her papers say that. And then this property sold to someone else. So the back half of her property was sold twice, basically. So yeah, that was an interesting case. It took a while. That took litigation, and what happened when, and all of that stuff. So sometimes even when you do the right thing, these things come up. Property lines is something else that comes up quite often. Because the fence is someplace, it doesn't mean that's your borders, right? So if you have, it's always also a good idea to get a survey, okay? And the survey tells you this is your property line, because I don't know if it's my people or not, but sometimes people just come and you want to put up a fence.
I'll
and
put
you
up my
just-
fence
You just
and
look,
I'm
you just
like,
give it the eyeball. You're like, oh, yeah, right, just to look good. You know what I'm saying? Right?
back home we had our fence was a feet away from what we actually owned. The neighbor put
Right.
up a fence and he took 1 feet over our property. We never
Correct.
made a big deal about it,
Correct.
but then when the fruit trees start bearing,
Uh-huh.
whose fruit is it? Is it
Yes,
yours or is it
yes,
mine? When the
yes.
drains, you have to do plumbing and all these things. Whose responsibility? It might
exactly.
look like a little property, a little sidewalk. In fact, I know a family in Guyana who had major walkway issues because in Guyana, just as Jamaica, between the properties you have a walkway.
Right.
They don't know. They decide to close that entrance,
Uh-oh.
and no one could get to their property in the back, which is, it was public property.
Right.
It wasn't, your fence was here, there was a public property. So they went against the rule and they were in
Right.
court for that right now.
Absolutely. Absolutely. So those are the things that you want to check, like on a physical level. And then the other thing that I would tell you, if you want to know if this is a good property or not, would be to first decide why you're buying a property, right? So there's some properties that make sense if you're going to rent it for profit.
You got to make some money out of
Right?
it,
So you're
right?
going to make money on a monthly basis. And there's some properties that make sense if you're looking for appreciation, right? So sometimes it may still be a good investment if you buy a property and the rent doesn't necessarily cover.
I
right?
know in a few
Because
years,
in a
certain
few
locations,
years-
certain neighborhood are going sky high. I want to get in there now, right?
Correct. So that's one way to look at it. And then there's a second way to look at it. And you need to be clear when you're going to buy, right? Because if you're buying for cash flow and then you're short, now you're stuck. Now you're like, oh crap, I got to come up with this extra money for
And
this thing, right?
And that is when some folks are forced to partner up with someone and bring someone else because they don't have that fund.
Right.
On one of my property, I was ready to close on it 2 days before they said it's an additional $12,000.
Wow, right.
So then I have to realize, where am I getting this $12,000 extra from to close on it? Because we look at a number, we make sure our numbers work for us. $12,000 is a lot of money for some folks. You don't
Right.
have that just to
$12,000
bring
is a
out.
lot of money. What do you mean for
Some folks,
$12,000
like, where are you going to pull that extra $12,000 from?
Right.
From yesterday's number to today's number,
Right.
a lot of things will change.
Right.
So,
Yeah, no. So those are the kinds of things that you want to look at. And as an investor, and here's the thing too, when you're an investor, you don't have the protections that you have as a homeowner, right? So you're in a contract, it's an LLC. The lender is like, hey, you're buying the house. They're not going to look and say, hey, they may not require a survey like a regular owner occupant would, right? The lender themselves may just say, hey, listen, as long as there are no objections on the title, we're fine. They're not going to ask you to get a survey to make sure that the borderlines are the borderlines. So you have to
make sure it's
extra-
suiting you, it's
Correct.
right for you and not for them, because when paperwork is done and you sign at the end of the day, that's when it's harder
yours. It's
to
yours.
fight. It's yours, right? So I'm sure a lot of folks might say, you know what, I live in Jamaica, I live in Guyana, but I would like some family member to buy property for me in New York.
Oh, okay. All right. That's a whole different level of financing, but it can be done. So there's some investor products out there known as foreign national loans, right? And I enjoy doing those loans because you get to meet people from all over the world.
Foreign national loans.
Yeah, foreign nationals. So now the key with those loans is that the person cannot have any U.S. status whatsoever, right? They need to physically, and their passport needs to be from somewhere else. So I've done loans for gentlemen in Germany, I've done the Philippines, I've done Holland, I have one person from Ghana. We never ended up closing, but we started the process. I can't remember what happened with physical property. But the key there is you cannot be a U.S. anything. You can't have any kind of passport, green card, temporary residence, none of that stuff.
You're not qualified if you own it.
Yeah,
If
if
you
you
live
have
here.
U.S. occupancy,
Right.
then you can't qualify under that program. And what's nice about that program is, and I'll tell this to real estate agents out there and property managers out there, is that though the property has to be here in the U.S., number one, but we will require that you have a local. At first, it has to be an LLC, right? So it has to be owned in a corporation, and the corporation has to be domestic. So that's how you get across the
So that was my
border.
next question. Can you buy in an LLC? So you could, whether you're residing in New York, can you buy into an LLC?
Yeah, you
Yes.
need to, particularly with a program like that, it has to be an LLC, right? So at the end of the day, the bank is going to say, hey, how do we protect ourselves if this loan goes bad? So if Auntie's in Guyana and she buy the house here in Queens where we are,
It'll be under my name.
it could still
It
be,
could still be under her
name.
name,
It could be in
okay?
her name, right? So she could be the owner of the LLC. The LLC could be here in New York. So she physically owns it because she owns the LLC.
Right.
But for the lender, if God forbid they have to foreclose, they're not foreclosing on Auntie in
Auntie, they're
Guyana.
foreclosing
They're
on-
foreclosing on the LLC here in New York, and that's how they protect themselves. But and the other thing about that is, if you now are a property manager, right? The lender requires that you assign a property manager, and typically it would be either a CPA, an attorney, a real estate agent who has the license and ability to like it. That's what they like.
All right.
Mhm.
So, ladies and gentlemen, we're talking with Mr. Conrad Gardner from Channel Mortgage. And I said, Conrad, is it your own mortgage company? He said, yes. So you know all the banks and how to work with different lenders.
Yeah. So yes, we do. So we are a brokerage. The way I explain that to people that's a little bit more familiar, I think about buying a cell phone from each of the phone companies and trying to figure out which phone carrier you want to A, carry their product, and B, figure out which
Okay.
plan that you are. You can go to, T-Mobile and Sprint.
Right.
and
They all have a
AT&T.
$50 plan.
They
That
all
suits
have
me.
Everybody has something. Or you can go to Best Buy, talk to one person that carries all the products, and they can objectively help you to decide which one is the
Okay.
best. So that's what my company is. So we do the exact same thing Best Buy does for your cell phones,
Mhm.
except we have
One under one
mortgages,
umbrella.
right? So we carry all the different products from a lot of different lenders. So when I'm talking to a client, I'm not talking from the perspective of any one loan program or any one lender.
You're talking what suits that
I'm
person.
talking to you about what's available
Available.
industry-wide. So there are oftentimes even, the folks will call me and just say, hey, listen, I'm stuck with my current lender. Is there anything out there? And I'm like, yes. And sometimes if you tell me the bank, I can tell you straight up, nah, they're not doing that loan. Right. Because
Someone
over the
else's.
years, right.
Yeah. Right.
And
Things
it's
change,
different.
right?
It's just like everything else, right? We all drive differently. Everyone has the same car. Some people drive at 90 miles an hour. Some people want to drive at 50. Some people want to barely get the car moving, right? Lenders are the same way. So even though they all lend, they
Mhm.
all have their own guidelines. They all have their own comfort zones, right? So it could be something as simple as your credit scores. Some lenders are okay with, a 620 credit score. Some will even go down to 500, 550, right? Of course, you're going to pay for it in other ways.
Mhm.
But there are also
You get
lenders
higher
that
rates.
want you to
Yeah.
be at 680 for the minimum program. So it's all your profile and the lender's risk tolerance. Those two things have to match.
Now, can you avoid using your own credit if you
Mm.
want an LLC?
Okay, how do I answer that one? That is good. Can you avoid using your own credit? Yes and no. And I say yes and no is that your credit would always be looked at. Okay, and we're looking at your credit to see what's happening with you personally, right? So the loan programs that are not credit score driven, they still want to look at your credit to see what's going on with you. Are you in the middle of a bankruptcy? Are you in the middle of a foreclosure? Are you so those
Not
things,
just because you miss a few bills or
right. And the programs that say, hey, we don't care about the scores, they still want to make sure that you're not in like financial chaos personally, right?
debt to income ratio.
No, we don't
No, they
necessarily.
don't
So
look at
those
that.
programs, those loans that don't look at your credit, they don't get into your debt to income ratios, but they do look to see, is this person okay? If you're buying using one of those loan programs, then the property has to be really strong, right? So then that's where we get into What's the strength of the property? What kind of cash flow is the property coming up? What's the neighborhood in the property? Oh, that's another thing too. We never really talked about. When you get into investment properties, depending on the loan program, sometimes a lender will say to you, "No, we're not interested." Why?
Right.
Because we're not.
Doesn't suit them, or
Doesn't suit them. It has a laundromat. They're
so they
too
have the
many
right to
managers.
refuse
Absolutely. On a commercial
on a
loan, and that's
commercial.
one of the differences, right? So if you are buying something as a owner occupant, right? Federal and state laws tell no lender can tell you
They
no.
can't deny you that loan.
No, you have to apply and you have to be approved or denied on your own credit, right? So there are laws in place that protects you for that. On an investment property, a lender may look at the property address, look at what you're doing, they go on the computer, they look what's going on the block. No, we're not interested. Too much going on that block. We're not doing we're not accepting your application.
And they have the right to do
Not even
that.
we're declining. We're not
We're not
accepting
accepting
your
it.
application, right? So that's something else that's different.
So there are many FHAs, give us conventional, many forms of loan out there.
Mhm.
Which is the best one for investment properties? As we're talking about today with Mr. Conrad Garner from Channel Mortgage, we're talking about investment property because a lot of folks have a personal property which have equity inside, and they're asking, how can I utilize my equity in buying an investment property? So there's a couple of ways we went about doing it, show proof of income.
Mhm.
And
Well, it's a two-part question. When you're buying an investment, the funds can come from anywhere, right? So you can get a gift fund for the whole down payment on an investment property, right? On an owner occupied, they're going to tell you, no, you can only get X amount of dollars.
Right.
And actually, that's not true. I think I might have sell this concession. Let me say that clearly. You can get gift funds on both sides, right? So that's not the issue. If you are going to buy the investment property, there's less stress on where the funds came from. The funds are there. They may say, hey, where'd you get the funds? The fund came from such and such. Okay, it's there. It's in the account. You're good to go. Versus you're going to live in the house. Who gave you the money? Did they have the money? Let me see the money.
you just give me an idea right now.
Right. That's how it goes.
We love to talk business, so you get to learn something every day. When you think you might not have option, there's an option. So you can avoid using your own funds. What if you want people?
Right. But then the second part, not to cut you, I'm so sorry, but I didn't answer the second part of your question is where if you own a house, can you pull equity out of your own house?
Right.
The answer to that is yes, you can certainly pull the equity out of your own house. But because it's your own house, right, you're still under the protections of the law. So we're still got to show documentation that you can qualify and,
Someone says a question came in.
Mhm.
They own the property, which is valued at 1.5 million. They owe $200,000. Can they take out the $200,000 in equity and pay off the original mortgage?
Okay. Yes, I guess you could. And the question is why?
You're borrowing at a higher rate. Your
take a home
original
equity
loan
loan.
might be 4%. You're borrowing today at what is the current market?
It all depends on credit, but
Credit.
right now, mortgage rates, generally speaking, right now floating between mid sixes into the sevens.
So
That's kind of
it's
where you are
still
right now. There's some that you could be in the fives, but for the most part, on the conventional loans, owner occupied, you're in the
so. In your
sixes.
opinion, for me, I don't think it's worth it. You're going to take out a loan for 6% to pay off a loan of 4%.
Yeah, that's why I asked you why.
Yeah. So
and
that wasn't
everything
very
is-
realistic
No,
for
but
me.
everything is contextual, right? So I have a client right now, and they are redoing two properties that they own. Both are at low interest rates, right? Both are in the fours. They're taking the money out, and they're taking money at 7.5, somewhere in that neighborhood. But it makes sense for them. What are
Because
they
they're going to
doing?
invest in
taking
it. They're
that
going to
money
make back
buy
money.
Right.
Right. As I always believe, you have a first property, a first investment, the money is there, your equity is growing. Why not take that out and invest it somewhere else that will bring in some money for you? So on that note, I would assume that would work. Ladies and gentlemen, thank you for watching. Let's talk business. We're talking today with Mr. Conrad Garner from Channel Mortgage. You could feel free to text him at the 917 number, 865-3402. He will definitely call you back, or someone from his we'll put the office number in there as well, and you could call him anytime, not 24/7. I hate someone when they call me before 9 o'clock or after 9
Right.
p.m.
You can usually, the office is open 9 to 6 p.m., 9 a.m. to 6.
Yeah.
And normally we make, if you reach out to me, I'll reach back to you and then we'll schedule something. The one, I would say two things, and I know you're trying to wrap the program. One about the interest rates, right? Think about interest rate like the price of gas. I say that to my clients all the time. It is what it is.
There's
right?
always three price there, though. You want super, you want.
And it's the same with interest rates, right?
Okay.
So you want to pay the lowest rates, you pay a little bit more, and you buy points. You don't want to pay the points, you take a little higher rate.
Right.
Your credit, you can affect, what grade of financing you get. So it's very, very similar. Funny, it's funny. I think I have a blog somewhere about that. But I always tell folks, it's just the cost of money. So if the cost of money is more expensive today, it's just what it is. It's,
Right. Market price.
So for folks who are like, oh, I'm going to wait for the Feds to do this, and I'm going to wait for the rate to do this, I'm always, I'm always in shock. And the reason why I say that I'm in shock is like, listen, the price of the house is going to be
The demand
price
is
of the
always
house,
there.
right? So as the price of the homes go up, and you wait for the rates to fall before you start buying, all that's going to do is push the price of the house further higher, right? So now you bought a house.
It's not
at a much
leveling
higher,
out.
so it doesn't necessarily level out. But here's the other thing: if you buy a house now and you can afford it, and the rates are high, and the rates drop,
You benefit.
you
get more
benefit because
money
you bought the
inside.
house cheaper,
Right.
and now you have a cheaper house and cheaper interest rate. So you can always change the interest rate. You can always change your loan program. You can't change the price of the house,
Right.
Unless
The demand is there. Sometimes you might be willing to pay for one property $1 million, and I might want that house so badly that I'm willing to pay 1.5 or 1.7 for that
Correct.
same property.
Right.
How much are you willing to spend versus what I'm willing to
Correct.
spend depends on the needs and the demands of the consumer.
correct.
Right.
And in a place like New York City or heavily densely populated areas, the demand isn't there's so much demand and there's such
There's
little real
no
estate
inventory.
that the prices are not coming down. So if you're waiting for rates to come down before you start looking, the rates are going to come down. All that means is just going to be more buyers in the market, and the sellers are going to be like, great, my price is my price. You guys fight it out. And before you know it, you're doing exactly that. You're overbidding for a property, and which creates some other issues down the road, but we'll skip that for another time.
So, I mean, a lot of folks are waiting. The minute they hear interest rate drop a little bit, it saves them a little bit, but how much?
Yeah,
Quarter
it
point,
saves
half
a
a
little.
point, it's.
And this is where what I'm about to say is going to sound counterintuitive, right? And they're going to say, I don't know what this guy is talking about. But I promise you what I'm telling you is fact. The interest rate that you hear that's being cut by the Federal Reserves, that is the interest rate that has to do with your credit cards, right? That's
Not
what
mortgage
that is.
rate and
Not your
investment
direct
rates.
mortgage
Okay.
rates. Your mortgage
See, a
rates
lot
are
of
more
folks don't
tight.
understand that.
Right. And the reason why the Fed's cut the rate, and if you think about it, why would the Fed be involved in interest rates at all, right? And how would they want to affect the economy? And the idea behind this is this. If the Fed says, well, this is the rate that businesses start to get money at, and this is the rate that business trade at to start, right? And if they set that benchmark rate at one level and it's higher, a business may say, hold on a second, maybe I'll wait a little bit because I'm in a business, which is exactly what's going on right now because of inflation, right?
Mhm.
So they're like, oh, hold on. So the cost of money is high right now. Now, if the Fed's cut it a little bit, then business owner may say, okay, you know what? I might hire that extra employee, right? I might buy that piece of equipment. But those are all business related loans. It has nothing to do with the long-term mortgage rates, which is more tied to the treasury. That, again, whole nother conversation, whole nother things. So I get that right now, today, the Fed's cut rate, it's great. I'm going to get the phone calls. And chances are, and the reason why the Fed cut the rate is they want to stimulate business.
They want everyone to
Right.
pay off the credit card or purchase more
Correct.
purchasing power, I
And
would say.
unfortunately, when that happens, it actually puts upward pressure on mortgage rates. So even though the Fed's cut rate, there's an upward pressure right now on mortgage rates until they kind of balance out. So will we see a lower reduction in mortgage rates in time? Eventually, but immediately, no. I know my phone's going to blow up tomorrow. Everybody's going to be like, I heard the Fed cut
They
the
heard
rates.
it,
All
yeah.
my clients, I heard the Fed cuts the rate. I'm like, okay. So I have my article that's ready to go.
Yes.
I'm like, boop, just got to send it out to folks.
So Conrad has a Facebook page. I believe it's Channel Mortgage.
Yeah, at Channel Mortgage.
At Channel
we
Mortgage.
just opened the page, so
Right.
please go on.
And I'm encouraging him to go out there with some daily tips and say, hi guys, this is what's going on,
Okay.
or, little things. So follow him, Channel Mortgage. You call him tomorrow at 917-865-3402 and reach out to him, see what it is, what's on the market for you, because the time for investment is always now.
Correct.
You want to start making money now.
Correct.
And if you could do it today, why wait for tomorrow?
Right. Absolutely.
So,
and one of the things too, if you are buying investment properties, your landscape is open, right? So you can buy an investment property in any state, any place where the budget and the income makes sense, right? So the investment property doesn't have to be in a highly priced place like New York City or another metropolitan area. It could be someplace in the outskirts. It could be upstate New York. It could be in a whole different jurisdiction, right? I have clients that are flying to what is that? Michigan, right? Detroit. They're buying properties out there.
I've seen a lot of land selling. They're
different
calling me
places.
up.
I mean, I have people buying.
I mean,
down
I
south.
remember a few years ago when Florida was developing, and they were telling you buy now. The land is 50,000 or 100,000.
Yes, yes,
You were
yes.
looking at it as I don't need it. Now a lot of folks are migrating to Florida, and property values are higher.
And
Than,
that's right back to why did you buy, right? So if you're buying for appreciation,
there you go. You benefit from
for
it.
all the years, you might have been paying that mortgage. You might have been paying into that loan. But now all of a sudden, that $100,000 purchase is now worth $350,000. Who won?
Right. Give
Right.
yourself a pat on the
Right.
shoulder.
There
Great
you go.
investment move
There
you
you go.
did, right? So
And if you were just renting out, and then here's the thing: if you're renting for income, you may not need to buy in a very
high interest.
expensive area, because when you do the math, right, you're buying at a high price, which means your mortgage rate is higher. Rent is just going to be rent, and there's going to be that differential after you pay your expenses.
And some folks can't afford the higher rent.
Correct. And then what happens, right? So in a lower market, you might be able to buy that property if you buy it for cash flow. And if it goes, for whatever reason, it's vacant for a number of reasons, it might be a little bit easier to carry, because you're now not, you're not dealing with the $5,000, $6,000, $7,000 mortgage. You may be dealing with a $1,200 mortgage, and that might be easier to carry in a different neighborhood. So you have to be clear in why is it that you are.
What advice you have for someone, as I said, when they're thinking of an investment property, what pointers would you give them?
Number one, I would tell you mindset, right? So if you're if you are looking to invest, you need to change your mindset about how you approach it. So the first thing in the mindset is know that you're not looking at 3.5% and 5% down. Those it doesn't exist for an investment, right? So and think about it. If you were the bank and I come to you and I say, hey, Shanaz, I want to buy a house. It's great. I'm going to make all this money. And then you say, hey, how much you have in? I go, well, I only have 3% down, but you want to give me the rest. But we're going to make a whole lot of money together. Oh, have you ever owned a house, Conrad? No, I never owned a house, but I'm telling you, we will make a lot of money. How comfortable would you be?
I wouldn't be comfortable. It's my money. You have to show me,
Right. And lenders, people think lenders are this mystical thing that just
they look at
happens
you. Oh my
behind
God,
the
he
curtain.
can't wait to have my mortgage.
They're human beings.
Right.
That runs companies to make a profit. And it's a human being that's making the decision. So
at the end of the day, your application approved, denied, or for some reason.
Correct.
So a lot of folks don't know how important it is keeping a credit score, maintaining a good credit score. This is like you're buying power, I feel.
Mhm.
Open a credit card. As young as my daughters are, I said, open a credit card today. Start building your credit. You want some sense of responsibility, your finances, So what is your take? I mean, if you have money, you don't need credit. That's what folks say.
Oh no, everything right now is credit score driven, because it's just part of the it's part of the fabric of finance, right? They came up with the whole idea of FICO scores, and it gives lenders, it answers one piece of the puzzle for a lender, right? And that's what's your behavior with
your finances, how you
credit.
manage.
How do you manage yourself? Has anyone ever lent you money before, right? So no one wants to be first, right? And not when it comes to financing, right? So a lender wants to say, well, how did you do with that last loan, right? I see you have, are you maxed out or you're not maxed out? Are you paying these things on time? Did you go belly up on the last
Right.
financing that you had?
And simply, if you can't manage a credit card, or, you have a $2,000 credit card and you're going to max it out all the time, well,
Right.
but you pay it off as well.
And having credit and building credit doesn't necessarily mean that you have to carry the balance, right? So if you open a credit card for your daughter, doesn't necessarily mean she has to keep spending money and carrying the balance on it. It could be buy a cup of coffee once in a while
And pay it off on time.
right? Because then what it shows usage. It shows that you have the zero balance.
Responsibility.
It shows that you don't need it every single month. So it's not a bad idea to have a credit card paid off, let it sit for a couple of months, and then use it again just so it keeps active, right? But it's one of the factors that go into your credit score is something called your payment pace, right? So when you have a slow pay, right, that actually hurts your score. So even if you're paying on time, but let's
Pay
say you start
minimum.
off with a right, exactly. You start off with a $5,000 balance, and
I
it's a
thought that would
year
be good for
later.
the lender. They want you to do
Well, it's
that.
good for the lender that has it. It's
Right.
not good for the guy that's looking to see should I come behind that lender.
Right.
You see what I
Because
mean?
the longer you have the loan or the credit, the better for them. They're gaining interest on that.
Right. So the guy that has
And
it,
you're
and
paying
again,
out of pocket.
I would ask you this,
Mhm.
right? If I came to you for a loan and you say, Conrad, do you have all the credit? Yeah, I borrowed 5,000 from Freddie
Oh, you have a
2
bad
years
track
ago.
record
Right?
that
No,
they
no,
sell,
no. I
right?
pay on time.
Okay.
But I borrowed $5,000 from Mr. Freddie Bank.
And how much
It's been
money
2
are you
years
paying
ago.
every year,
It's
month?
2 years ago. I've been paying him, and I've been making the minimum payments, and I still owe him $4,800.
Not a
Right?
good track record.
I pay on time though, right? But you're kind of feeling like, well, maybe you're at your max because it's $5,000 and you still haven't knocked out the
Maybe the
balance yet.
interest is less on it, and there's more priorities
There
that
could be
he's
all of that
looking
factors. So you can't take one
scenario
alone
alone.
to just say that's just the one, but it's just the concept. So the concept is you have a whole bunch of credit cards and it's been years and you still have pretty much the same balances because you've been making minimum payments. Your scores actually go down, even though you pay on time, because again, you haven't knocked out.
I
the
feel a little bit
balance.
better about myself because that's what I did last week.
There you
I
go.
paid them off and I decided, okay, let me put some more balance on them,
Okay,
booking a
there you
couple
go.
of vacation,
Okay,
So I thought that would be worth it.
There you go. At least you
But
get
I
it down
hate
to zero.
keeping a balance knowing that you have a credit card of this X, Y, and Z
Right,
amount.
right,
Just
right.
pay it
Exactly.
off and start over and do
Exactly.
something again, reuse it.
Exactly.
So guys, thank you for being in our company. We're talking with Mr. Conrad Garner from Channel Mortgage. He's looking forward for your calls tomorrow, 917-865-3402. And do hit him up on this Facebook page as well, Channel Mortgage. Give him a follow. I'm encouraging him to get on TikTok because you know what?
Whole different world. Okay, I'm leaving. I'm getting out from behind the desk and coming out and talking to folks. So,
Yes, social
yes.
media and networking is quite important. I met Conrad a few years ago at one of our business
Yeah,
networking
business network function, yeah.
with our friend Kishav. So thank you, Kishav. It was a great. I love the network with folks.
Yes.
Go out to events, you meet folks just like yourself. And I thought of a question, and I thought of Conrad. So here we are today, a week later, and Conrad is on a program talking about mortgage investments. If you like a particular topic, shoot a message to me, and I'll have Conrad on the program again discussing about that. But in the meantime, reach out to his office, reach out to his cell phone, 917-865-3402.
Leave the office number because chances are, I will say this to folks: if you call the cell phone, you don't get me, should hang up, leave a text, and someone will get back to you. I'll shoot you off to one of the team members, or call the office directly at 718-639-9500.
I will put that in the chat as well. So guys,
639-9500. Yep.
thank you guys for being in our company. We enjoy being here. The SMS network in the App Store, Roku TV, and Fire TV. 24/7. You could view our program, share the link, let everyone know that you're watching us. I got someone call us from Trinidad, and we'll be having some great news with a program coming from Trinidad as well. Suriname, it's an international platform. If you have a smartphone, you could watch us from anywhere, basically. Thank you to our YouTube and folks who are watching us from Homeland, Guyana. Any closing statement you would like to say? I mean, the time is now to invest. You're investing in yourself. If you have the finance, you have the funds, why not do it?
No, absolutely. And when you invest, particularly in real estate, you're looking at a long-term horizon. And think right now, for those of you who have young children and families, right, look at what the prices of homes are. Ask your parents what they pay for their homes, right? And you'd be like, oh my gosh, I can't believe it was so cheap.
Right.
You want your child to be able to say that to you, even though the numbers are a little bit more astronomical. But yes, I paid $1 million for this two-family, but now it's worth $2.5, $3, $4 million. And I've seen that in my career. I've seen $500,000 properties that are now trading at $3.5, $4 million.
Wow.
In my career, right? So
I'm sure
it's
they're
not
smiling
even-
all the way to the bank, or just knowing you have all that
absolutely.
security
Absolutely. You just
is
bought a house and you're a millionaire. You haven't done anything. You're not, taking all the risks that a lot of business owners are doing and working, 50-hour weeks and 70-hour weeks. You bought a house, you paid the mortgage, and you bought in a great area. And
Great investment is better than
the
putting the money in the
appreciation
bank and wait for it,
Oh,
wait for
sure.
interest.
Buy the right property. Yeah, absolutely.
Well, when it comes to buying, call Access 24 Homes, the beautiful Rosanna Beaumont from Access 24 Homes. We also have Mr. Mohid in the studio, so we're going to go chat. Let's get a mortgage. Let's buy a property today. Thank you for being in our company. Until next time,
Right.
we hope to have Conrad again on our program, bringing you some more informative information on investments. Good night. Take care. God bless you. All the best to you and yours.
Yes, thank you so much for having me.
Thank you for being here and
Alright.
bringing some great investment news. Take care.
Take care.